the real story is gold has the ability to hold value in terms of buying power, because how else are we going to put a value on it? Fiat currency certainly does not. And that's where the real story is. So you've got something that's stable throughout, the last couple hundred years, and something that year after year, month after month, day after day, year after year has less buying power than the previous month or the previous year. And then you're going to go, wow, gold's rise is spectacular. The real story is the dollar's downfall is devastating.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Boehm. Today we have a fantastic discussion lined up. We're fortunate to have with us Gary Wagner, CEO and executive producer of the goldforecast.com. Gary's been a technical market analyst covering the precious metals for over 35 years. Gary, welcome to Metals and Miners. Thank you so much for joining us today.
Thank you so much for having me. It's an exciting time for us in the industry to be looking at gold and conveying what we can to our subscribers, viewers, and followers. Yeah.
You're absolutely right. All right, let's jump in. President Trump is threatening the BRICS nations with 100% tariffs if they move forward with any attempt to circumvent the US dollar. How do you expect the BRICS alliance will respond, and what would the impacts be on precious metals?
Well, the BRICS alliance has been getting stronger year after year, but they haven't really gained what I'll call global momentum and traction. I think the dollar is going to stand or fall, be strong or weak relative to the currencies that we're kind of weighing it against on its own, and whether or not that is the preferred monetary currency that large corporations use to transact business. In other words, the dollar is going to have prominence because the major players, global players, continue to use it. If everyone switches over to the euro, regardless of what BRICS is trying to accomplish or not, if the global powers, and I'm talking about corporate powers more than anything else, transact their businesses, their trade, using the dollar as their primary go-to currency, that's really what's going to give the dollar strength or weakness when we compare it to whatever else out there. And the only thing I can think of really is the euro that could have any kind of dominance. And so I don't think it's so much up to BRICS per se, as much as, I hate to say it, but large corporations that are moving money around.
Okay. So Gary, gold's chart looks fantastic. Its breakout looks like a breakaway. But gold is also a barometer for the global monetary system. Is the breakaway that we're seeing in the gold chart a warning that something big is brewing under the surface?
It's an interesting question. I mean, gold moving higher has multiple components. And the newest one is our new administration, the new president, and all the wrenches he's kind of throwing into what we've come to expect in terms of economic policy, political, international policy. Gold's dominance and ascent to unheard of prices a few years ago. I mean, I remember middle of 2011, that first run up when I got trapped because at 1900, I was sure it was going to 2000, and we re-entered the market, and boom, that's when it dropped and never looked back. In fact, had a multi-year correction from 2012 till the end of 2015-16, when it went down to 1,020. And that was in a February. And what I remember is that's when George Soros stepped in and started buying huge positions of gold. And what I was taught by a couple of my mentors that I highly respect is follow the big boys, because it's not that they're privileged to inside information, but these are traders that year after year have had exquisite performance, excellent results. And if they're buying, there might be a reason they're buying, and whether you can figure that out is not as important as unless you have a different take and have theorize that they're wrong, their assumptions are incorrect, is kind of play with the money or follow the money. And so that's what we see. But the root cause of gold's ascent, historical, monumental move, is not really the story of gold, because gold has had a relatively flat level of buying power for years. If you think of it this way, if you go back to it's 1910, right at the beginning of the 1900s or 20th century, excuse me, you had a $20 gold piece or a $20 currency note. And with that note, you could actually buy a nice suit, get a nice room, not a suite, but a room at the plaza, go out and have a magnificent steak dinner. Back then, it cost about $1.50, and have money left over from the $20 gold piece or the $20 government issued fiat, or not fiat, but currency at that point. We were on the gold standard. Fast forward that to 20 years ago, 10 years ago, or today, if you have a $20 gold piece or a $20 bill, the buying power is not equivocal. It's really fallen apart. And so what I'm trying to say is gold has intrinsic value. There's only so much of it. It costs money to mine. This is where your expertise would come in, not mine. I look at the charts, not necessarily how a mine produces and the costs and all of that. But once currencies fell off of any kind of standard, the gold standard is what we've been. And prior to that, gold and silver were actually minted as coins, but as a bartering system to transact trade, whether it's between people, companies, countries. Once that was decoupled from having any real value, and the country that issued it, meaning in this case the United States, started spending more than they took in each year, in other words, creating this huge budget and fiscal deficit, the buying power of that dollar went down. Gold stayed relatively the same. In other words, the buying power of gold hasn't moved up or down significantly in the last 100, 200 years, but fiat currencies have. And that's the real story here. The real story is gold has the ability to hold value in terms of buying power, because how else are we going to put a value on it? Fiat currency certainly does not. And that's where the real story is. So you've got something that's stable throughout, the last couple hundred years, and something that year after year, month after month, day after day, year after year has less buying power than the previous month or the previous year. And then you're going to go, wow, gold's rise is spectacular. The real story is the dollar's downfall is devastating. I mean, the buying power has just contracted by, 10x, 20x, whatever it is. Gold remains intrinsically valuable, will always have value. At least
That's
my
well
opinion.
said. Yeah, that's well said. Yeah, that's well said. Well, let's take a look at the charts. I'm
Sure.
sure there's something in the gold charts that you want to show us that's informing you of where you believe prices are going in the short term and in the long term.
All right, I look at charts typically through what's called a Japanese candlestick. I'll blow this up. And the difference between a bar chart and a candlestick chart is they both have a vertical line. The bottom represents the low of the session, top, the high. In a bar chart, there's a little horizontal slash. On the left-hand side represents the open, and a little slash on the right-hand side of the vertical bar that represents the close. A Japanese candlestick chart uses the same 4 data points, open, low, high, and close. However, they draw a rectangle around the open and closing price, and then they color it in 2 different colors, whether or not a market closed above its open or below its open. And the key distinction or difference is When you think about it, it is the way the Japanese or Eastern technical trader thinks and where he puts his primary focus on. My belief is that the Western trader puts a majority, the primary focus in terms of change of price in a market in gold, on its closed relationship. So if I told you gold gained $6 today, you and I intrinsically understand I'm comparing the closing price yesterday to the closing price today, right? To the Eastern technical trader, he believes that the most important relationship to understand about a session in trading is where gold opened at the beginning of the session and closed at the end of the session. And the rationale is that the Eastern market technician views each day, each trading session as a battle. And the outcome of that battle can be graphically illustrated in a Japanese candlestick by the size of the rectangle and the relationship of the rectangle to what we call the wicks, which is the relationship between the open and closing real body and the high and the low. So, for example, if you're looking at the chart, you can see that today gold is up fractionally when compared to its open. That's why it's a green candle. And we're comparing this price here to yesterday's candle, which means that yesterday gold opened at 29.38 and it closed at 29.27. The real picture is it traded to the all-time record high of about $2,968 and an intraday low of 29.06. Today, gold made a lower low than yesterday. It certainly didn't challenge the high that came in yesterday. That stands as the highest intraday value for gold in the history of gold pricing. In terms of a close, it would be the day before. It would be Monday, this large green candle, because the top of this rectangle signifies where gold closed during that session. The bottom represents the open, and you'll notice there's very small wicks or differentials between the real body and the low and the high. This type of candlestick, when we look at it today, and then I'll give you an idea of my my macro view. If you can look at the size of this wick that came down to 28.86, and the fact that gold's range between where it opened and where it closed a little bit higher than the opening price. The real story is when this market sold off, and that's what, about $35, $38 lower. Market participants saw that as an opportunity to buy the dip and quickly took it off the lows and recovered to a point where gold is back above its opening bid. Granted, it's fractional, but nonetheless, it's near the top of the range, and it didn't even close negative like the red candle on the prior day. Now,
Gary, and if you don't mind me interrupting.
Oh, I'm sorry.
No, you're fine. If you don't mind me interrupting, at the beginning of February, there's a very large green candle, and then there's a red, and then there's a similar. No, go back to the beginning of February, right? Where
Well, this is okay. This is December, January, or do you mean last February?
No, right there, February. There's a bit. I wish I had control here, but just keep going to the right. Keep going. Right there. Yeah. What comes after that, the red and then the small green with the deep wick, it looks very similar.
Yes, it does. It looks very similar. This gap here, and it's not a true what we call price void because you have a wick, but it's a void of real bodies. I believe this occurred when most active contract month changed, and that's why you got this price gap. But you're absolutely correct. These are very similar to where you had a tremendous move to the upside, a retracement that in the case of what happened in the end of January and February, recovered
Right.
maybe or took back maybe a third of the price. This is much less, maybe what,
Mm-hmm.
20% of that. But the following day, you had a very small bodied candle with a
Mm-hmm.
very large wick,
Mm-hmm.
meaning the differential between the high and low and that real body. Very good
Those,
observation.
yeah,
What
those
that,
three. Yeah, go ahead. Yeah, they look the same. Those 3 days look the same.
yes,
Similar.
yes.
Similar.
Okay. So, and they do. And then what we want to realize is this rally really started middle of December and so far has resulted in gold increasing by about $370. So that is a pretty sizable rally because what you'll
Mm-hmm.
notice is that I've looked at these rallies that occurred last year and basically looked at the price move and the percentage move. Now, the percentage move is going to change because as gold becomes more valuable, a $100 move is not the same percentage move as it was when gold was at 1800 or 2100 or whatnot. But $370, 375, and then the largest rally that we saw last year, which was a $450 gain in one leg. And so we've already seen gold move in terms of the increase in value to indicate a sizable change in value as it's paired against the dollar. And as we talked about on the last question, that change has two basic components: market sentiment, meaning are traders actively bidding and selling into current pricing, or are they going long current pricing? That market sentiment is one component. The other component is going to be dollar strength or weakness because we're pairing it against the dollar. So there's 100% correlation between the percentage move in terms of dollar strength or weakness, and then that's added in addition to or taken as a force moving against it. But nonetheless, we have seen gold rising now for the 18th. We're going on well over a month, almost a month and a half, 2 months. And time wise, that's about what we've seen in these rallies. They typically don't last more than a month and a half to 2 months. We've seen periods back in the middle of 2011 and 12 when we had that first historical climb, when we had an extended rally that took a half a year, and then we had a multi-year decline from once it peaked out at the new all-time record high back then till it found support almost 50% at having a value.
Are you expecting a pause, or are you expecting a pullback here?
We haven't seen many pullbacks. I think that what we have seen is anytime, and that's for an example today, anytime we've seen these lows come in, it's created a perceived opportunity that resulted in investors, market participants, traders stepping in and buying the dip. And so, unlike moves where we've seen gold move up and then correct, this would probably be about a 60% correction. Here, a respectable correction can be 50 to 61 or 78% of the move up. A shallow correction is typically 28 or 38, 23, excuse me, 38. These are Fibonacci numbers that we plot in. But during the rally, we haven't seen anything except what I'm calling a one-off or two-off days. And what I mean by this is you get a rise in one day, one red candle, then it returns to green. And they're kind of intermixed all the way throughout this chart, except if I convert the chart, and give me a second here, to what is called a Hinkenashi. Just give me 1 second here. And you
So,
notice the difference in the chart, how that changed the chart? It's
Mm-hmm.
still a candlestick chart, but it's a Japanese average. That is a Henkinashi. The only difference here is how they're fixing the open. On a Japanese candlestick chart, the open is the true open. On this type of chart, the open is derived from the midpoint of the prior candle, and that's where it becomes an average chart. And so it smooths out the trend and allows us to get a empirical mathematical gauge of strength of trend, and also a key to when it might pivot. If you notice, you get almost all green candles on the way up, just like you got all red candles on the way down. Here is a good example. You get these large red candles, the lack of upper wicks, which is what we look for in a correction. Then you get these pivotal candles. Body size gets really, really small. It changes to red, goes back to red. Then you get a couple of greens, a couple of reds. That's that pivot. That's that point in time when the dynamics between the bullish faction, those that think that current pricing is attractive and it's going to go higher, and the bearish faction changes hands. So obviously the bearish faction dominated market sentiment during this correction or any correction. We saw it kind of flirting and trying to change hands. That took 5 trading days. And then once the pivot occurs, you get a predominance of green candles. And then this last part of the move, beginning at the end of January, the start of February, these candle size, look at how large they are when we compare them to these. And so that tells you the trend had a huge amount of momentum that was basically put into the market because market participants were actively bidding or buying, going long gold. And then it kind of waned a little bit, but we got a return recently to these large candles. And here we have the potential as a pivotal candle. And what does that say? We know that on a candlestick chart, we had a red candle here, and that made a big difference. I'll turn this back and then we'll go back to the discussion.
So you're looking for maybe 2 or 3 more days of those smaller mid-tier candles, and if we get those, then we could be looking at this changing of the hands, so to speak, and then we could anticipate a decline of 28, 38, or as much as 61% on the Fibonacci.
Typically,
Okay.
but this is not a typical market.
Yeah. Well, no, I understand. I
Yeah.
understand that. So let me ask you this: if looking at the charts, are you able to get a gauge for where you think gold is going price wise by the end of 2025, maybe even by the end of this particular bull cycle?
As a market technician, meaning I look at numbers and charts, the primary tool that we use daily has been taken away, and that's historical data. How did gold react at $2,830 or $40? I have no clue. It's never been there before. Once we went, and that's what this dotted red line represents, and that's also where this big spike to the upside occurred, is once we went to all-time record high closes and high prices, which is these series of trading days, the technician is void of any of that historical information that we would use to say, well, last time gold was at 3,000 an ounce, this is what occurred. It's never been there. And it is for that reason that what I've fallen back to is we have had rallies in which gold has gained $300 or $200 or $400. So that's a historical reference that I can make. And based upon that, if the current rally, and this is just one leg of multiple rallies that we will see over this year and next year, by the way, this is not where I think gold's going to hold and never surpass. This rally still has the ability, in terms of relative strength of former rallies, of moving up another $100. So another $100 from the high today would take it to 3,070. If you compare it to the close, a little bit below that. I think to answer your question, short term, I believe that gold will break above 3,000 and it could begin to get overbought anywhere between $3,050 and 3,100 short term before it enters a actual correction. And by definition, we look at a correction as a price decline of 23 or greater in terms of the percentage decline. A stock moves from $1 to $2 and starts to correct, we needed to see it go down $25 before we label that as a shallow correction. And
So Gary,
38%.
your comment about it about that you believe it still has $100 of play to the upside in it is interesting because the number you used was $3,070. I believe, if memory serves me correct, $2,070 was the old high back in March that we kept bumping up against 5, 6, 7, 8 times before the breakthrough finally happened.
Okay.
And so from a psychological perspective, that 3,000, 3,070, that similar number makes a lot of sense.
Right. But there's a big caveat to all of these statements I've just made. And it's not that I'm trying to fabricate something that I don't believe in. It's what I believe in. But my analysis is based upon former past history, what the relationship that we have seen over the years on a mathematical basis. And the truth of the matter is, numbers don't matter. It's fundamental events that move gold higher or lower. And so as long as the fundamental events are still in play, meaning the geopolitical conflicts we've had in the Middle East, as well as Russia and Ukraine, those were top performers in terms of moving gold over the last couple of years. Now it's Trump's revision of international policy regarding trade with the tariffs and the reciprocal tariffs. And the bottom line with tariffs is it hurts everybody, no matter where you live, because reciprocal tariffs mean that if you're in China, in Britain, in Switzerland, in Australia, in the United States, and Canada, your currency buys less than it did the previous month, the previous half year, the previous year. And wages typically don't advance in the same way that inflationary pressures advance. That would be nice, but there's typically even a lag there. And so as long as the fundamental underlying factors that make up the fabric that has caused the dollar to do whatever it's done and caused gold to do whatever it's done, if they remain, it's not hard to imagine that the bullish market sentiment for gold, which currently exists, will continue to dominate investors and traders' inner thoughts and market psychology as to which way they're placing their bets, they're putting their money. And so
that's well said. Well, we could take the chart down now, but speaking of, that market sentiment and that that worldview here. Gary, I got a question for you. Today, Barrick Gold, 500 million free cash flow in the fourth quarter. Current free cash flow rate at $2,900 gold puts them at $3 billion free cash flow. They reported that their costs were down. They announced a share buyback. So all of this sentiment that you were just talking about, well, shares jumped 6%. It pushed the entire index up 5 points. Agnico Eagle, they report on Friday, and they're expected to have free cash flow of 800 million. The GDX and the GDXJ, they're both up 15 to 20% since New Year's. Do you believe that the highly anticipated move in the miners has finally begun?
That's a question that I don't feel as though my answer would give any valid insight, because there's all the variables that you just named. In other words, what their free cash flow refers to is you've got to take what they're producing gold for per ounce, which means per ton of dirt mined or whatever, however you quantify it. And their free cash flow is the result of a combination of what it costs them to mine it and what they can sell it for. And since I don't have an intrinsic understanding of how that varies from mine to mine, producer to producer, and all of the minute details that going into how a mine produces that X amount, because the price is the price for every single mine, right? But the cost of production, I would imagine, can be quite different from mine to mine, and the amount they produce is going to be different from producer to producer. And so those are variables that aren't intrinsically not that they're not understood by me, but that I don't factor those variables in when I look at the price of gold, because
Okay.
I'm looking at it. Yeah, I'm looking at it from traders and investors, not producers.
I understand. Okay. Well, this has been a wonderful discussion. Before the final question for Gary, I want to direct everyone to our Substack at metalsandminers.substack.com. We offer content on the consumer, the economy, markets, artificial intelligence, specific metals, miners, and all the expert interviews that we conduct, just like this one with Gary. They're all up there. When you subscribe, you get a free report titled "If You Don't Own Gold, You Know Neither History Nor Economics," explaining why everyone should own gold. Our premium subscribers have access to the Inner Circle, featuring 2 to 3 monthly expert analyses, plus the Critical Reports Library and the Asset Sentiment Tracker. The Sentiment Tracker is also exclusive to subscribers on the premium side. It monitors expert sentiment on assets like gold, silver, miners, copper, uranium, oil, the Nasdaq, and the S&P 500. The latest Inner Circle report was published February 5th by Simon Hunt, and it explores the upcoming copper cycle. So go to metalsandminers.substack.com, subscribe for your free gift, and consider our premium service for these exclusive insights. Also, I'm positive you've enjoyed the conversation with Gary as much as I have. Please let him know, hit the like and subscribe button, and leave a comment below the video. All right, Gary, there's a lot going on in the world where silver is needed. I know you've had your eye in the charts for silver. You know, we have the deficit, and we have the need for, with the AI build out and the electrification of everything, the weaponization of everything. All of this requires mass amounts of silver. What are you seeing as far as the charts are telling you about silver?
Right off of the top, the first thing that comes to mind is what I'm seeing is a disconnect between where we've seen silver's value climb to or decline to, the relationship between the gold and silver ratio, and whether or not, because there's all kinds of theories that abound, conspiracy theories with silver, where large institutional traders are coming in and they're artificially holding it below a certain value or propping it up. I have no idea. What I can say is that I believe personally, and this is what I do for myself and my family, is I take part of my income on a monthly or bi-monthly basis, and I put a percentage of that into physical possession of gold and silver. I've been doing it for years. My grandfather was a gold trader in Europe. It's kind of in my blood. I've conveyed that to my 2 sons, which have cherished whenever they had a 10-ounce bar of silver or a small coin of gold. And I've taught them that there's intrinsic value in this that can't be found in other things. Real estate and land's always going to have that intrinsic value, but the liquidity is a different issue. But gold and silver, for centuries, for thousands of years plus, has been used as a way to barter or transfer value and facilitate trade amongst people, tribes, groups, or countries. And that's not going to change. So as far as the service you offer is concerned, if it offers valuable insight, it's actually priceless. Whatever your premium subscribers are being charged, if it gives them insight that makes them better investors or traders, it's really priceless. And so you can weigh it that way. That's not going to change. Gold and silver will always, I believe, have intrinsic value that cannot be duplicated by any fiat currency, period.
Okay. And so but you, just to make sure I understand, you're seeing a disconnect between where you believe the value of silver should be and what the charts are saying the value is.
I'm sorry, I didn't answer the question. Absolutely. Considering that when we had the first major run up in gold, 2011 to the middle of 2011, 2012, and it runs to 1900, all-time record high. Silver also runs to about 50. Now, granted, the difference back then was you had these two brothers called the Hunts brothers that were attempting to take over and take over the silver market. They got banged and artificially moved it up. But we've never seen silver recapture that kind of glory from the glory days. Whereas in gold, gold and silver both had multi-year corrections. They both began to move higher off of the lows that occurred at the beginning of 2016. But silver never really recaptured, at least for me, that excitement of moving past $35, $40, even coming close to challenging the record highs. And to answer why that's happened, to me, is not as important. I'm glad because I don't know why, but it's not as important as knowing how to place your investment dollars, how to allocate, what to do with it. And the bottom line, as I just addressed, is everyone should take a component of their income and utilize that to add to their portfolio physical accumulation of gold or silver. Even if you can only buy a couple ounces of silver, 10 ounces of silver every 2 months, the key is to allocate a portion of it. You know, any investment, financial investment advisor, and I come from that field, is going to say you need a percentage in fixed incomes that have a high level of security, government bonds. Then there's US equities that make up a component because they have that upside potential, risk on and risk off. And then you have safe haven assets in which gold is the primary player. And then you've got silver, platinum, and palladium to a lesser degree moving up and down. But the most sensitive of those four metals has been gold. And silver just hasn't had that same kind of upward momentum as we've seen in gold. I still buy silver, and I buy silver because I think the glory days for silver hopefully are still here to come, and it's relatively inexpensive to buy it at $30, even though I remember when my aunt used to give me a real silver dollar every Saturday to go out in the weekend and go buy candy with it. You know, when we're talking 60 years ago. But I remember that silver dollar as being different than a dollar bill, even though they were relatively of equal buying power back then. This is the end of the 50s, beginning of the 1960s. That's always stuck in my head. And so silver will always have intrinsic value. It just hasn't been able to compete with the historical rise in gold, to answer your question.
Yeah. Well, Gary, thank you for coming on to Metals and Miners, being so generous with your time, analysis, and ideas. Would you please let everybody know where they could learn more about your work and how they can connect with you?
Thank you. Absolutely. I do a daily article for Kitco Media, Kitco News, Kitco.com. I've been doing daily articles for the last 13, 14 years. You can always go there. Our website is thegoldforecast.com, as well as our YouTube channel is The Gold Forecast, in which you can look at historical videos. We do 5 a week. Then there's about 2,000 videos up on YouTube that you can look at and see what I said when gold was doing this or silver was doing this, historically speaking. We also offer a premium service for those investors and traders that believe that that could help them in any way, we'd like to offer a small discount. There'll be a little box that says code, and if they type in one word, metals and miners, beginning tomorrow, we're going to let them have, for a limited amount of time, about a week to 10 days, 30% off our regular subscription price. So a way for them to try it out. If you do the monthly, you can take it for a month. If it's not of value to you, please drop it. We won't charge you for it. We don't want you to pay for our service unless you're really gaining something from it, if it makes sense. If it doesn't, we would rather you don't spend your hard-earned dollars and get our service that's not helping you. And I'm sure you feel the same way. We work really hard to deliver quality information and actionable information that helps investors and traders have better performance. And if we can't do that, we shouldn't be charging. We shouldn't be doing it. So yeah, thanks.
Okay. Yeah. Well, I will put all that information up on the screen. I will also have links in the description area for everybody, so you guys can click through. Follow Gary, follow his work, go take him up on this offer, check out some of the charts that he's putting out, the videos, learn what he's doing. It is a value add. Gary, I look forward to having you back on sometime soon. Thank you for being here with us. Everybody else, thanks for watching.
Thanks for having me.
To our Substack at metalsandminers.substack.com. We offer content on the consumer, the economy, markets, artificial intelligence, specific metals, miners, and all the expert interviews that we conduct, just like this one with Gary. They're all up there. When you subscribe, you get a free report titled "If You Don't Own Gold, You Know Neither History Nor Economics," explaining why everyone should own gold. Our premium subscribers have access to the Inner Circle, featuring 2 to 3 monthly expert analyses, plus the Critical Reports Library and the Asset Sentiment Tracker. The Sentiment Tracker is also exclusive to subscribers on the premium side. It monitors expert sentiment on assets like gold, silver, miners, copper, uranium, oil, the Nasdaq, and the S&P 500. The latest Inner Circle report was published February 5th by Simon Hunt, and it explores the upcoming copper cycle. So go to metalsandminers.substack.com, subscribe for your free gift, and consider our premium service for these exclusive insights.